My name is David Taylor, company is Sheridan Accounting, and today we're going to talk about 5 easy ways that you can lose control of your business. It quite often comes up. People start their business, they carry on, partners they originally started the business with fall out. So it's always these things are always difficult, and the accountant normally gets involved in them at the beginning when things go wrong. We always try and recommend to people, get a shareholders agreement in place. Quite often these people will go, we're okay, we've shook hands and we're okay, we're going to be fine with this. Whether that's partners, family or whatever it is, it doesn't really matter. They go, we shook hands on it, we'll be okay. It's like, no you won't. You need a shareholders agreement in place because that's the rules and regulations of how you're going to operate, very important. But because they're the rules and regulations of how you're all going to operate together and how you're all going to do business together, it's not just about the here and now, it's about the future things. So if you're putting loans into the business, each of you is putting a loan into the business, it's important to know when that will be paid back, how it will be paid back, what will happen if it's not paid back. So that your friends now, you're all putting this money in, you need to know if something falls over or goes wrong or you need to change tack. You need to know how you're going to get your money back and how things are going to, how people are going to behave. And also when you're doing this, get your solicitor involved. Get a solicitor involved and make sure that they write it in plain English and not in legalese, that what you thought was going to be your shareholders agreement turns out to be something that's not what you wanted. And with the solicitor, make sure everybody's involved with the solicitor as well so that they can see. That they can't advise each person, but what they can do is make sure that what you want is what's in the agreement. So, shareholders agreement, if you haven't got one in place, it's a very easy way that you can lose control of your business and everything fails. Because the first thing you do when you set up a business is normally you go to friends, partners, people you know, bring your money into the business so that you can start off and go forward. Links quite nicely back to the shareholders agreement because that's the importance of having these things in place when you do have family, friends and partners. Because the first time you realise that you're losing control of your business is when you fall out with these people and they've got loans in the business, they've helped you, they've funded your business and now they're going, I want my money back. The business isn't doing very well, I want my money back. Help. So fallouts with family and friends and partners is always difficult and always a thing that you don't want to do. So when the money comes into the business from them, make sure you've got a shareholders agreement in place because then everybody knows what the rules of the game are. Private investors, also known as Dragon's Den people. People that they've been in business, they've made some money and now they want to give back. But sometimes the stake they want to take is more than you want to give. So always be careful with that you're not giving more away. And in the event that you're giving it away, you need to be able to know that in the future that you can also get that back. You can buy your stake back so that you can maintain control. Sometimes they will want to take a big stake in it. So if you've got a 50% stake or if you've got a 100% stake, they may want to take a 50% stake, which initially it looks like, oh blimey, I'm losing control. But sometimes it can be the catalyst that you need to move your business forward on the basis that you can always gain control back by buying them back out or buying part of their stake back so that you maintain control going forwards once they've helped you move the business forward. So there's always tricky things, but it's very easy to lose control of your business with things like that. Venture capitalists get their money on the money market. That they've got a big source of people that they can ask money from. They can get money from the money markets, whereas a private investor, it's their own money. It's money that they've made through buying and selling companies. Venture capitalists, it's not their money. It's that they are a group. It's groups of investors rather than just a single private investor. Recently come across a company that have used this option. They've maintained control because they've built their company to a certain point. They needed £200,000 worth of investment. Venture capitalists came in, and I think it's going to be more than 200,000, actually moved the business forward with a good chunk of money. And their stake in the business was a minority stake in the business. So you can get investment, you can get money coming in, but sometimes venture capitalists will come in and, a bit like your Dragon's Den people, will want a much bigger stake and will effectively, almost looks like they want control of the business. So just be careful when you're doing things like that, because they can cut you out and literally take your business over. But if you're going public, then you do need their help. And you know, if you're going public, then you're likely to make a lot of money. So losing control of your business, yeah, hey ho. Oh yes. Now, here's a really good one for you. Giving away shares. People have friends, family, and the instance I'm thinking about is the person literally gave away his business. Yes, I can see you now going, gave away his business? How could he do that? What happened was, a person came in, did some work for him, said, not a problem, rather than you pay me, give me some shares. And at the time, 5% shares, great, not a problem. It's a minority shareholder, no problems. And then as time went on, it was like, well, I'm actually needed over here, I'm going to do this, you're running the business for me, I'll give you a few more shares. And eventually, over a period of time, they gave away over 51% of the shares. So effectively, they gave away control. They literally just gave away control. And without thinking about it and looking back at it now, they go, ah, yes, maybe I shouldn't have done that. And literally, they lost their business by giving away shares. And I know you're looking at me now going, how can somebody do that? It's been done. It would have been far better if the person had actually just paid them a salary. But they were doing a good job, they were managing the business for them, give them some shares, and he ended up losing the business. Hope you've enjoyed our video today. If you'd like to find out more, you can visit our website and sign up for our monthly newsletter, or you can just watch another selection of our videos on 5 easy ways to whatever in your business.